Hi, ladies and gentlemen, and today thank you for joining us for this very important program about market collapse. So, today we will dive into the murky waters of the complex world of financial markets. We will investigate the factors that lead to a market crash as well as its effects and talk about the tactics that may be used to make it through turbulent times. Hold on your hats because we are about to go on an adventure to explain the phenomena of market crash. So first let's understand market crash. So before we can have any hope of understanding market crashes, we need to have a fundamental understanding of how supply and demand work in financial markets. The combined activities of buyers and sellers are what derive markets. And when fear, uncertainty, and negative emotions prevail in the market, it leads to quick and abrupt decrease in prices, often known as market crash. Now we will understand the reason behind crashing stock markets. Crashing of a market can be used by a variety of events. A negative spiral can be triggered by a variety of factors including but not limited to economic recession, geopolitical tension, unforeseen corporate scandals, and even excessive speculation and irritational optimism. It is essential to determine these factors in order to acquire an understanding of warning indicators that occurred before an incident. Impacts of market crash, which is the third segment of market crash. A severe decline in market value can have a significant impact not just on individuals and companies, but also on economy as a whole. As market price continues to fall, retirement savings continue to fall, and faith in financial institution continues to erode. Investors may be in for huge losses. The repercussion will have a rippling effect throughout industries, which will result in job losses, decreased consumer spending, and a slow down in economic growth. The fourth segment will cover historical crashes of market. Let's adopt a historical viewpoint and investigate some of the important market crashes it that have influenced the current state of the economy. The infamous Wall Street crash that occurred in 1929, the dot com bubble burst that occurred in 2000, and the global financial crisis that occurred in 2008 are the events that we need to investigate in order to learn from the lesson. Now, tactics to employ in the event of stock market crash. So first of all, maintain composure and make sensible decisions are absolutely necessary in order to protect your wealth. It is possible to reduce exposure to risks by practicing diversification, asset allocation, and keeping a long term perspective. In addition, we will go through strategies for protecting portfolios such as dollar cost averaging, value investing, and the utilization of stop loss orders. The impact of people feelings on stock market is the topic of the sixth segment. During times of severe market instability, emotion tend to play a large influence. The effect of collision can be made significantly worse by irritational decision that can result from fear and panic. During these times, potential during these potential dangerous times, we will discuss how to control your feelings, how to control your discipline, and make decision based on accurate information. The seventh segment we will discuss is the role of government in making markets stable. As we all know that government plays a major role in making the market stable. When there is a threat of market meltdown, government and central banks frequently step in prevent a future damage to the economy. We are going to have a conversation on monetary policy, fiscal stimulation, fiscal stimulus measures, and regulatory reforms with the goal of restoring confidence and prevent future economic turndowns. Opportunities amid market crash is a topic of eighth segment, hosted by crashing markets bring unpredictability, but they also provide investors with chances that they would not otherwise have. In spite of the economic slump, we will investigate several investment tactics such as contrarian investing, finding undervalued assets, and analyzing market trends in order to locate prospective growth regions. The ninth segment, lessons learned from recent market crashes. Crashing market can teach investors, governments, and financial institutions important lessons. Therefore, it is important to pay attention to them. In order to forestall or lessen the severity of future market crashes, we will discuss the significance of effective risk management, enhanced regulation, and investors' education. The road to recovery and looking ahead to future. In final part of the video, we will talk about steps involved in getting back on your feet after a market downturn. Historically speaking, the markets have recovered and the economy has proven to be resilient. In this video, we will discuss the significance of gaining wisdom from previous blunders, adjusting investment methods, and keeping a long-term view in order to ensure future market stability. Now, crashing markets are natural and unavoidable element of the way the financial institutions work. Ladies and gentlemen, we are able to minimize risk and maximize opportunities if we grasp of the factors that lead to these turbulent times. The effect those factors have and the tactics that may be used to transverse them. Keep in mind the best way to navigate through market crashes is to maintain a high level of knowledge, control your emotions, and use sensible investment practices. We are grateful that you have chosen to embark on this informative adventure with us, and we will wish that all your investment will be successful despite whatever challenge they may face. Maintain vigilance and make decisions based on information you have until the next time. Now let's discuss about the dot-com crisis. Now this crisis surrounding the dot-com industry. In first section, we will provide an overview of the dot-com financial crisis. To begin, let's go a better understanding of what dot-com crisis is. Commonly referred as to a tech bubble or internet bubble was all about. The term dot-com crisis refers to a time that occurred between late 1990s and early 2000s. During this time, there was speculative frenzy surrounding enterprise that were based on the internet. Now, this exuberance caused a jump in stock values of technology business, often with little or no earnings, which was then followed by a claustrophobic drop. The cause of the crisis. Now let's take a look at some most important factors that led to the dot-com crisis. First, the hype around technology. At the end of 1990s, the technology was a still relatively new phenomena, and there was great idea of excitement surrounding it. Investors were mesmerized by the possibility that internet-based enterprises may displace more conventional business and fundamentally alter the world. Because of all the hopia, there was a significant influx of capital into technology sector. Investments in the speculative market. The dot-com crisis was characterized by investment in the speculative markets. Investors poured money into internet startups frequently without having a complete knowledge of the business strategies. employed by these companies or the potential for them to have a great income. There have been several firms that have drawn large values while having negligible profitability, perhaps mainly concepts. Third, irritational exuberance. Alan Greenspan, the former chairman of the Federal Reserve, famously referred to this point as irritational exuberance. It describes the excessively optimistic mindset and the expensive valuation that predominated in the market at this time. A self perpetuating cycle of speculation was driven by the enthusiasm, which drove stock values to astronomical levels. The repercussion of the crisis. Now let's take a look at the effects that dot-com crisis on the economy and the things that we can take away from it. The decline in the market technology. When the speculative bubble burst, stock prices of many technology companies plummeted, resulting in significant losses for the investors. A significant drop was seen in Nasdaq Composite, which is largely impacted by the performance of technology stocks. Failure in the business world. A large number of dot-com enterprises have filed for bankruptcy, particularly those that had robust business model of income sources. This led to loss of complete employment opportunities as well as wave of disillusionment among investors who have bought into the hype. A realignment of valuation. The dot-com crisis acted as a wake-up call for investors, bringing to light the significance of fundamental analysis and reasonable valuation. It caused investors to become more cautious about the viability and profitability of internet-based enterprises, which led to realignment of expectations as a result. Now let's see what are the lessons that we learned from the dot-com crisis. And these lessons you need to keep in mind for future so that if any crisis happen, you take or you keep all these points in mind before taking any kind of action. So the first lesson, prudent business model. It is impossible to overstate the significance of prudent business models. Before making an investment, potential investment potential investors in a firm should perform an exhaustive analysis of the latter revenue generating potential, competitive advantage, and long-term sustainability. The importance of profitability and a defined route to achievement can be overstated. Now, how to avoid the herd mentality? The dot-com crisis taught us the dangers of falling prey to the herd mentality. If you if you don't do your research and just let go with the flow of the investment decision making, you could be setting yourself up for failure. It is critical to be able to think for oneself and to arrive at well-informed decision after conducting in-depth research of examination. Thinking in the long term when it comes to investing, investors should adopt a mindset that is focused on the long term. Volatility and enthusiasm was a short period of time might impair judgment. It is possible to better weather market volatility by keeping one's attention on fundamentals and by investing in firms that have a significant potential of sustainable growth. Diversification. Diversification is an essential technique for risk management. It is possible to learn the impact of market downturns by diversifying one's investment over a number of different assets. Now we understood everything about the dot-com crisis. Now we will move to the second crisis that happened, which is the 2008 financial crisis. Now we will navigate the complex web of factors that led to disaster and the investigation and to investigate the long-lasting consequences it had on people, organization, and government all across the world. Part one: the event that led up to the accident. To have a better understanding of the scale of the market meltdown in 2008, we need to look back at the years leading up to the event. We will take a look at the housing bubble, the crisis will subprime mortgages, and the emergence of complicated financial products that helped pave the way of imminent calamity. And in second section, we will focus on determining what root causes are, lex lending standards, securitization of subprime mortgages, excessive risk taking by financial institutions, and poor regulatory monitoring were some of the factors that contributed to the meltdown of 2008. In order to acquire a full grasp of these components, roles in the crisis, we will study each of them individually. Now, the domino effect is covered in the section 3. The subprime mortgages crisis immediately sent reverberations throughout the whole global financial system as it was developing. In this video, we will investigate the interconnection of institutions, the contagion effect, and the rapid loss of trust and the confidence of financial markets. Now, impacts on economics across the globe is the topic of fourth segment. The market meltdown had that had occurred in 2008 had repercussion that was felt by individuals, business, and economies all across the world. We will investigate the failure of key institutions that ensuring freeze of credit markets, the precipitous rise in employment rates, and the subsequent global recession that followed. In fifth section, we will discuss the reaction and intervention of the government. As a direct response to the crisis, government and central bank took a number of action to stabilize the economy. We will examine the unprecedented bailouts, stimulus packages, and regulatory reforms that have been implemented with goals of stimulating economic growth, averting the collapse of the system, and restoring the confidence. Lesson learned from the crash is a topic of sixth segment. The financial sector, government authorities, and individual investors all gained critical knowledge from the 2008 market crisis. Now, let's discuss. The role of credit agencies is also discussed. The financial crisis of 2008 was largely exacerbated by the action of credit rating companies. We investigate this procedure, any potential conflicts of interest, and the level of scrutiny that were subjected to after the crisis. In addition to this, we will investigate the changes that have been made to improve the credibility and autonomy of credit ratings. The housing market and real estate lesson is the topic of 8th section. The collapse that occurred in 2008 was triggered by problems in housing market. We evaluate the significance of the housing bubble in terms of lessons that were learned from it, such as the significance of responsible lending practices, correct risk management, and the requirement for sustainable expansion in real estate sector. Lesson from individual and investors is the topic of ninth section. The financial crisis that began in 2008 has a significant and lasting effect on individual investors as well as institutional ones. When it comes to successfully navigating unstable financial markets, we discuss the significance of diversification, responsible debt management, and the maintenance of emergency fund and taking a long-term perspective. Now looking ahead, market stability and risk mitigation is a topic of 10th section. As we reflect on the market catastrophe that occurred in 2008, we need to think about the action that were done to prevent a crisis of similar nature from occurring in the future. In order to keep the market stable, we take a regulatory reform, stress testing, improvement risk management practices, and the necessity of maintaining constant attention. Now, now that we have established what's been going on, we will investigate the possible reason for it and discuss what the future holds for us. So let's get started. The introduction to the worldwide financial crisis is presented in section 1. To get started, let's exactly define what it means when we talk about a crisis in a global market. It is shorthand for a precipitous and prolonged fall in stock values, which has repercussions for a wide range of economies and industry all around the world. This phenomena has the potential to have far-reaching implications which could have an effect on economic enterprise and individual investors. The crash and its causes. Now let's have a look at some of the important elements that have played an important role in the current fall of global markets that we are experiencing. Slowdown in economic activities. One of the most important factor is the current state of the global economy. Several of the world's most important economies are currently struggling to overcome obstacles such as disagreement over trade policies, political unpredictability, and a protected epidemic. Because of these problems, consumers have cut down on their spendings. Business have invested less money, and the economy as a whole has grown more slowly. Now, concerns regarding inflation. Another factor is rising inflation. There has been an upstick in inflation rates over the great deal of the world, which has raised concern about the likelihood of central bank tightening monetary policies. As in, as investors reevaluate their holdings in preparation of rising interest rates, market volatility has increased as a result of this anticipation. Tension in the geopolitical arena. Geopolitical tension have also played a role. Uncertainty has increased as a result of trade disputes, political conflicts, and international issues, which has harmed investors' confidence. This unpredictability causes people to seek refuge in safer assets, which can lead to a drop in stock markets. Now, impact and possible repercussion. Now that we have gone over some of the things that contributed to the situation, let's take a look at the impact and potential implication of crash in the worldwide market. First, deterioration of wealth. One immediate consequence is the deterioration of wealth. When stock prices fall, the value of investors' portfolios goes down, which has an adverse effect on this overall financial well-being. This fall on wealth can also alter consumer purchases pattern, further worsening the issue faced by the economy. Performance in business. During times of market instability, businesses in all kind of different fields face a variety of challenges. A decrease in the price of their shares can make it more difficult for them to raise funds, which can lead to fewer investment being made on possibly even layoffs. In addition, decreased consumer spending might have an effect on corporate revenues, which can further hinder business successes around the economy. A crash in the global market could have more severe repercussions for the economy around the world. A slowdown or even a recession in the economy could be the result of decreased consumer spendings, falling investment levels, and the decreased profitability among businesses. This has the potential to set off a domino effect, which would have repercussions for nation, companies, and individuals all across the world. Now, what to anticipate going forward? Even while things may bleak right now, it is essential to keep in mind that conditions are cyclical, cyclical, and it's not important for conditions to improve, and it's not impossible for conditions to improve. The following is an outline of what we should anticipate moving forward. Volatility in and uncertainty. We can expect increased market volatility and uncertainty in the near term. It is possible that stock values may continue to go up and down as investors react to shifting economic conditions. Now, in new geopolitical occurrence, it is critical to maintain a cautious stance and give serious through to long-term investing strategies. Policy intervention. During time of crisis, government and central banks frequently step in to try to restore order to the finance markets. They may choose to implement measures such as modification to interest rate, fiscal stimulus packages, or regulatory reforms in order to regain the trust of investors and to promote economic recovery. Downturns in the market can present possibilities for investors who are clever. Market downturns can present opportunities for investors who are savvy. When stock prices go down, certain assets become cheap, which might be present possible buying opportunities for investors who hold position for long term. And when navigating such unpredictable markets, however, it is very necessary to carry out exhaustive study and act extreme cautious. Now the conclusion. In conclusion, the collapse of the global market has caused shockwaves to spread across the world of finance. The decline can attribute it to a variety of issues, some of which include a slowdown in the economy, fear regarding inflation, and the tension in global affairs. The repercussions are extremely widespread and will have an effect on individual companies and economies all across the world. Nevertheless, it is essential to keep in mind that market has historically rebounded for declines, and the chances may present themselves with no volatility. As always, it is essential to stay informed, diversify your investments, and consult with financial professionals in order to make informed decisions during the time of uncertainty. We hope that by listening to this financial crisis, you have gained some insightful insights into the recent collapse of the world market. Now we will talk about the 2010 flash crisis. To get started, it is important to comprehend the nature of flash crisis that occurred in 2010. On May 6, 2010, the world's financial market witnessed a precipitous drop that was unmatched in the speed, followed by equally quick recovery. The occurrence, which is frequently referred to as crash, serves as a jarring reminder of the risk connected with high frequency trading and activity driven technology in the market. The causes of the crisis, as described in the section, now let's take a look at some of the most important aspects that had role in the flash crisis of 2010. First, high frequency trading, sometimes known as HFT, high frequency trading, which is distinguished by quick trade execution made possible by the application of sophisticated algorithm, played a very crucial part in crisis. HFT companies have become a dominant force in the market because of their ability to execute trade in a matter of microseconds by using powerful computers and intricate algorithms. Nevertheless, the high competitiveness and interconnection among the businesses created a fragile ecology that is subject to upheavals. Problem with market liquidity. During the flash crisis, liquidity, which refers to how easy is to buy or sell assets, completely evaporated in the market. This took place as a direct result of abruption withdrawal of liquidity sources, which set off a chain reaction of automated selling orders. As price fall precipitously, market players had difficult times finding buyers, which made the downturn spiral even worse. Weakening in the market structure. The market structure itself had vulnerabilities and exacerbation exacerbated the crisis. The quick transmission of selling pressure was helped by the interaction among automated trading system, algorithmic trading, and various trading venues, which amplified the market collapse. The impact and the consequences of the situation. Let's take a look at how the flash crisis of 2010 affected people and what's its after effect. First, the volatility of the market. During the flash card, stock prices plummeted in the matter of minutes, erasing trillions of dollars worth of market value. This tremendous volatility caused investors to be thrown into a state of panic and uncertainty, which ultimately led to loss of confidence in the financial markets. Second, confidence of investors. The crash has a significant impact on the confidence of investors. After witnessing the abrupt market drop, many retail investors remained hesitant to participate in the stock market because they were afraid that another incident of this nature could completely wipe out their assets. Regaining the confidence of investors became an absolutely necessary challenge. Now, the response of the regulatory agencies. In the aftermath of the crisis, the regulatory bodies such as the Security and Exchange Commission (SEC) scrutinized the events and implemented measures to prevent incidents similar to those that occurred in the past in the future. Circuit breakers and trader halts were introduced in order to create a buffer during times of significant market stress and to reduce excessive volatility. Now, market reforms and the observation and the lesson learned. Now that we have covered the aftermath of the flash crash of 2010, let's look into the important lessons that were learned and the measures that were put into place to prevent future disaster. First, risk management. The flash crash brought to light the significance of establishing and maintaining stringent risk management procedure in order to stop automated systems for worsening market volatility, market participation. Especially high frequency traders need to have appropriate risk in control. Market surveillance. Improving our capabilities for market surveillance and monitoring is of the utmost importance. In order to keep the market from becoming unstable, regulators need to keep a careful eye on all the trading activity, look out at any abnormalities, and act quickly. Now, transparency and accountability. It is essential to improve transparency and accountability in the markets. Participants in the market are obligated to make the trading technique and algorithm they use transparent and easy accessible to the public. In addition, the authorities should have right to examine and penalize any trading practices that are manipulative or abusive. Coordination among regulators. The flash crisis of 2010 brought to light the necessity of improved coordination among global regulatories. Because of the global interdependence of the world financial markets, it is essential for the various regulatory organizations to work together and share information in order to effectively handle systematic risk. The conclusion and some closing thoughts are the flashcard of 2010, the flash crisis of 2010 was an important event that brought to the danger posed by high speed trading and the intricacies of today's financial markets. It brought to light that necessity for more stringent rules and improved risk management practices and increase. So now, in conclusion, in this video, we discussed what is market crash, how it happened, and then we looked at various events that happened in past. Now, let me know your thoughts in the comment section. What do you think about the market crisis and how you can prepare from it? We have seen many strategies. We have discussed many strategies which you can use to save yourself from financial crisis, from any kind of future financial crisis. Also, we discussed what things you need to keep in mind in order to prevent your wealth during a financial crisis, as trillions of dollars are wiped out during financial crisis, and we need to make sure that whatever money we are investing in the market, we need to protect them, we need to safeguard them. So we need to follow some steps and guidelines in order to do that. Just don't blindly invest in anything. First research and analyze. If you want, you can take help of professional investors, and then only come to a conclusion and invest in any kind of stock. Before that, please don't invest, and if you're investing, please keep all the points in mind that we discuss in the video. Thank you guys, and happy investing. The first portion will provide an introduction to silver and as an investment. Let's begin with the high level of discussion on silver as an investment before delving into the specifics of the analysis. Silver status as a valuable precious metal will with a diverse area of application in the industry has been well established for a long time. Additionally, it is an asset that is commonly sought for during times of economic instability. Since it is regarded as a safe haven, silver is frequently included in investment portfolios by investors as a way to diversify their holding and protect themselves from the effect of inflation. The second segment will discuss the factor that influence the price of silver. Silver's price is determined by various variety of elements, and it is essential to have a solid awareness of these factors in order to carry out an appropriate analysis. The following are some important consideration to keep in mind. First, demand from industry. The price of silver is significantly impacted by the fact that it is used in a variety of industrial applications. Alterations in the demand of silver from sectors such as the industry, the solar energy industry, and the healthcare sector can have an effect on price of silver. Second, condition in the global economy. Silver prices are influenced by the general health of economics of the world. Silver demanded Silver demand and price tend to increase during the times of economic instability because investors seek for safe haven assets such as silver in large numbers. Inflation and the movement of currencies. Number three, because inflation eats away the value of fiat currencies, investors are fleeing to real asset such as silver in order to protect their wealth. Alterations in currency markets, particularly shifts in the value of the dollar, can also have an impact on the price of silver. Recent trend in the price of silver are covered in this segment. Now, let's have a look at the recent pattern and trend in the price of silver market performance. Through time, investing in silver performance over its whole history might reveal extremely useful information. The examination of historical price fluctuations, such as the economic crisis of 2008 or the COVID epidemic, might assist in the identification of possible trends and patterns. Silver prices are highly sensitive to shift in supply and demand, which has a direct and inverse relationship with one another. Price may go down when there is excess supply, but they may go higher when there is a disruption in the supply chain or an increase in industry demand. Technical analysis trader and investors frequently made use of technical analysis in order to recognize price patterns, level of support and resistance, and reversals in trends. Moving averages, the relative strength index, and Fibonacci retracement levels are common examples of technical indicators. The fourth number will provide the projection for price of silver through 2030. Now that we have covered, let's talk about the prediction for the price of silver in 2023. It is essential to keep in mind that it is impossible to accurately forecast future pricing with complete accuracy. Nevertheless, we can create educated estimates by conducting research on a variety of criteria. Predictions made by analysts. We are able to take consideration estimates made by analysts and recognized financial institutions. The forecasts are supported by considerable research as well as insights gained from the market. It is vital to take into consideration a variety of sources in order to achieve a holistic perspective. Factors relating to macroeconomics, conducting an analysis of the pattern relating to Macroeconomics can provide a large framework of silver price estimates. See, price changes can be attributed to a variety of factors, including interest rate, forecast of inflation, and development in geopolitical situations. The mentality of market participants can have a significant impact on the price of silver they are willing to pay. Silver performance can be affected by a variety of factors, including the degree of investors' optimism or pessimism, the degree of political stability through the world, and the volatility of the market. And as we come down to our silver investigation, it is essential to keep in mind that market of silver is intricate and is affected by a wide variety of circumstances. Investors can improve the quality of their decision by engaging in in-depth research, maintaining awareness of developments in the global economy, and taking into consideration the perspective of industry professionals in spite of the fact that we are unable to make accurate predictions about the future. Those who are considering investing in silver could benefit from gaining an awareness of factors that influence the price of silver and keeping abreast of the most recent market trends. The forecast for the price of silver in 2023 is covered now. Now we are going to delve into fantastic world of gold and examine the price in its price of year 2023. Let's begin with high level discussion on investing potential of gold before delving into specific analysis. See, gold is one of the precious metal that is most known and recognized all over the world. It has been used as a store of wealth, a hedge against inflation, and a safe haven asset throughout the course of history. Whenever there has been a economic unpredictability, gold is frequently held inside investment portfolios by individuals seeking to diverse their holdings and protect their existing wealth. Now we will discuss the factors that affects the price of gold. See, the price of gold is affected by a number of different elements, and it is essential to have a solid awareness of these factors in order to conduct an appropriate analysis. The following are some important considerations that you have to keep in mind. First, the current status of global economy has considerable bearing on the price of gold, which moves inversely to precious metals. Investors frequently seek the security of gold as safe haven during the time of economic instability or geopolitical conflicts, which drives both the demand of gold and its price higher. Gold is commonly regarded as hedge against inflation, particularly when interest rates are high. It is possible that the value of fiat currencies would decrease, forcing investors to seek refuge in gold. This can happen when inflation rises or when central banks slash interest rates. The value of US dollar and the movement of other currency both have key effect in the pricing of gold. A stronger dollar can put downward pressure on gold prices, while a weaker dollar can push gold prices upward. Gold is priced in dollars. Therefore, gold can push a stronger dollar can push gold prices lower. Now let's have a look at the recent trends in the price of golds. So, performance through time conducting a thorough examination of gold performance over time can offer extremely beneficial insights into possible patterns and trends. Analyzing price fluctuation, particularly those that occur during the times of economical turmoil or volatile market conditions, might help one find crucial market markers for the likely behavior of the future prices. Gold prices are affected by supply and demand dynamics. The price of gold is affected by supply and demand dynamics of gold. The amount of gold that is mined, the amount that central banks buy or sell, as well as the demand of gold jewelry, are all factors that influence the availability and demand for gold, which is an which in turn affects the price of gold. Now the technical analysis. Traders and investors frequently make use of technical analysis in order to spot and trend in the price of gold. indicator like moving average and the relative strength index RSI, as well as chart patterns and support and resistance levels, can provide valuable insight into prospective price movers. Now, the fourth part that will cover the projection of gold through 2023. Now, that's the out of the way. Let's discuss the much anticipated estimates of gold prices in 2023. It is essential to keep in mind that it is impossible to accurately forecast future pricing with complete accuracy. Nevertheless, we can create educated estimate by conducting research on variety of criteria. First, respectable financial institutions and professionals frequently publish their prediction for the price of gold. These forecasts take into account a variety of factors, including macroeconomic trend, decision about monetary policy, and geopolitical developments. When developing a holistic perspective, it is necessary to take into account information from a variety of sources. Factors relating to macroeconomics condition, conducting an analysis of macroeconomics indicators such as inflation, interest rate, and projection of economic growth the production can provide light on price fluctuation of gold. Gold prices are also affected by a variety of other factors, including the practices of central bank, trade conflicts, and the political stability of the world. Market sentiments and investors' behavior are two factors that might influence gold prices. Gold prices can be affected by several factors. The demand of gold is a safe haven, can be affected by a variety of factors, including a person's appetite for risk, the volatility of the markets, and the performance of other asset classes such as stocks and bonds. The final segment is the conclusion as we came to end of our investigation. It is essential to keep in mind that gold market is affected by a wide variety of elements, and as a result, it is susceptible to a degree of volatility and the fluctuation. Investors can improve the quality of their decision by engaging in in-depth research, maintaining awareness of developments in economic conditions around the world, and soliciting and considering the advice of industry professionals. Now we will delve into subject of silver mining and talk about the downtrends in the amount of silver that is being produced. So first, let's understand silver mining. Let's have a fundamental understanding of silver mining business under our belts before we go into the reason behind the precipitous drop. The extradition of bearing ores from the earth crust and the subsequent processing to achieve pure silver are both necessary steps in the mining process for silver. The mining of other metals like copper, lead, and zinc typically results in production of silver as a byproduct. And the second part of this video of the mining of silver will focus on the factors that led to the decline. And the numbers and there are a number of reasons for the mining industry to step down, including silver. Let's analyze some main causes. First, depletion of high grade deposits. Many of the world's largest and highest grade silver deposits have been extremely mined over the years, leading to decrease in availability of these deposits. This has led to a depletion of high grade silver deposits as a direct consequence of this. The deposit in the deposit that are still present typically have lower grades, which make the mining of these resources economically viable. Exploration obstacles. It has been increasingly difficult to find a fresh silver deposit which possesses challenge for explorers. Search for silver resources of excellent grade has grown increasingly difficult as a result of high cost and length of time required by exploration of silver. Third one is environmental rules. The great monitoring of mining operation is that a result of tighter environmental rules as well as the concern of local population. Mining business will find it much more challenging and expensive to operate in a profitable manner as a result of these restrictions, which require adherence to stricter environmental requirements. The unpredictability of silver prices can have an effect on the profitability of mining. Mining operations might not be profitable when silver prices are low, which would lead to less money being invested in exploration and production of silver. The implication of the decline are discussed in the third portion. The reduction in mining has a number of repercussions that can be seen in other industries in addition to mining business. Let's have a look at some of the most important repercussion. First, first is limit in supply. The falling production of silver may result in limit in the supply of silver, which may then cause imbalance between the supply of silver and the demand of silver. This has the potential to exert upward pressure on silver over the long term. Second, demand for industry and technology. As we know, silver is used in a wide variety of industries such as healthcare, electrical components, and solar panels, amongst them. A fall in silver output may have an effect on these industries, which may result in increase in cost and loss of innovation. Among both investors and traders and the financial markets, silver is seen as a precious metal and a potential alternative investment asset. The reduction in the amount of silver mined is likely to pique the interest of investors, which could result in an increase in the demand of silver supply currently available, so pushing prices higher. Now we will cover a look into the future as well as possible solutions in spite of difficulties that are now being experienced in the mining business. There are possibility potentials solution that lie ahead. Let's have a look at some of the most important aspects. Number one is technological development. Developments in mining technology such as enhanced exploration techniques and more efficient extraction process can help counterbalance the reduction in silver production. These developments can assist compensate for the shortfall in silver prices. These advances have the potential to open up a new deposit while simultaneously improving mining efficiency overall. Number two, recycling and reclamation. Increasing effects in silver recycling and reclamation can assist supplement the dwindling supply of silver. There can be accomplishment by increasing recycling and reclamation initiatives. Recycling efforts can assist in recovery of silver from electronic trash, jewelry, and other sources, in addition to widespread application in a variety of products. Number three, exploration and investment. Continuation of exploration efforts and investment in the silver mining sector are essential for discovery of new resources and in resuscitation of production. Silver's potential long-term value must be acknowledged by government, the mining industry, and the investors before resources can be distributed appropriately. Environment sustainability encouraging environment responsible mining practices and minimize the impact of silver mining on the surrounding environment are two ways to assist alleviate the effects of increasing stringent laws. The adoption of environmentally responsible mining practices will not enhance the image of industry but will also secure its continued profitability in long term. So in conclusion, as our investment into the downtrend in silver mining, it is essential to acknowledge the multi faceted character of the problem. The depletion of high grade resources, the difficulties associated with prospecting, the constraint imposed on the environment, and the fluctuation in prices of silver have all contributed to the fall. Nevertheless, there is a possibility and potential solution that can help lessen the effects of the consequences and design a more sustainable future of silver mining. The silver mining sector is capable of overcoming these obstacles if it adopts technical advances, encourages recycle and reclamation in the initiative, increases exploration and investment, and places a priority on environmental sustainability. In order to accomplish this goal, government, mining firms, investors, and any other relevant parties will need to work together. As a potential investor, customers and citizens of the world, we have a responsibility to remain current on the latest trends and advances in the silver mining sector. If we have a better understanding of the dynamics of industry, we will be able to make decisions that are more informed. Whether those decisions concern our investment, our consumption habits, or our advocacy for environmentally responsible mining practices. Now, let's discuss the issue of the declining trend of global gold output all over the world. So, first, we will understand the gold production, like how gold is produced. So, let's start. First, let's have a basic understanding of gold production under our belts before we delve into the reason behind the recent decline in the prices of gold. Gold is a precious metal that holds a high value and has been sought after commodity for many years. Extraction of gold bearing ores from the surface of earth is the first step in manufacture of golds. This is followed by operation that is refine the gold into the purest form. It is extracted using variety of methods such as open pit mining and underground mining. Now, a look at factors that led to decline. The decline in gold production is attributable to number of important contribution causes. Let's take look at some of the most important factors included. First, declining reserves. Many of the world's largest and most accessible gold deposits have been extensively mined over the years, leading to decrease in reserves. The remaining resources are frequently more difficult to access, buried deeper underground, or situated in remote demanding locations. As a result, the extraction process is both more expensive and more technically difficult. The mining of gold has been increasingly expensive as a result of variety of variables, including the cost of labor, the price of electricity, and restriction pertaining to the environment. As a result of increased expenses, mining enterprises may find that lower grade deposits are no longer economical viable, which may lead to decline in the production. Geological difficulty, the process of discovering new gold resources on a significant scale has gotten more difficult. The process of geological exploration is getting increasingly difficult with necessities that use a cutting edge technology as well as significant financial investments. As a direct consequence of this, the number of important gold finds have has decreased in the turn has restricted the possibility of expanded production. Now, the fall in production, gold production has a number of repercussions that can be seen in other sectors in addition to mining business. Let's look let's have a look at some of the most important repercussions. First, constraints in supply. The falling production of gold may result in supply constraint, which could ultimately lead to imbalance between supply and demand. Considering the sustained high level of demand, this may, over the course of time, exert some upward pressure on gold prices. Second, second, impact on economics. The mining of gold has considerable impact on the economics and many different languages. particularly in those places where the primary industry, a drop in gold production, may have favorable repercussion of labor markets, the economic surrounding areas, and the revenues that government receive from mining activities. The opinion among investors have been that gold is both a safe haven asset, a store of value for a very long time. A drop in production, a drop in gold production may pick the interest of gold investors, which might result in demand of precious metal, possibly push up its price, and investors look for ways to hedge their holdings of wealth. Now, prospective look into future and possible solution. See, there is an issue to be faced as a result of decline in gold production. However, there are potential solution and future views to take in consideration. Let's have a look at some most important aspects. First, innovation in mining technology. So, innovation can boost the efficiency of gold extraction, making it economically viable to mine lower grade deposit. The production of gold in future may be aided in part by technological advances such as enhanced mining practices, streamlined operation, and cutting edge exploration strategies. Second, investment and exploration. Continual investment in geological exploration is essential for the purpose of locating new gold, discovering and restocking reserves. Gold potential is long term value must be acknowledged by governments, mining firms, and investors, and then only sufficient resources be allotted to sustain exploration operations. Number three, recycling and the circular economy. The efforts to increase gold recycling and the implementation of circular economy concepts are two potential solutions to the problem of decreasing supply. Gold can be recycled from variety of sources, including jewelry, electronic waste, and other materials. This decrease the demand of new mining operation, encourage the management and resources in an environmentally responsible manner. Now, in conclusion, the downtrend of gold output is a complex issue that is driven by a variety of factors, including diminishing reserves, increasing cost, geological constraint. The repercussion of this decline are not limited to mining industry. Rather, they will have effect on the supply as well as economics and investor sentiments. However, there are potential future views to think about such developments of new technologies and increase in exploration investment and the promotion recycling and the principle of circular economy. It is necessary for those who are interested in gold market, both as investors as well as consumers, to be updated about the trends and the movements in the industry. When we have better understanding of the factors that influence gold production, we are in a better position to make educated choices regarding our investment, our consumption, our habits, and our advocacy for environmentally responsible mining practices. So, we are grateful that you participated with us in the investigation of declining of gold output and also about the silver output. We have seen how the silver and gold prices are affected by the current market trend and also what are the future prediction of gold and silver. We sincerely hope that you discovered this study to be enlightened and thought provoking. Please leave a comment below if you have any questions or would like to express your thoughts, whether it would be positive or negative. Remember to give this video a thumbs up and subscribe to our channel for more enlightening stuff related to money management and the stock. So, according to me, the gold and the silver prices will keep on increasing. As we have seen, there is a decline in supply of silver and the rising demand. And also for the gold, as you know, the central banks are buying gold, and the 2023 of Q1 has recorded the most amount of gold that is being bought by the central banks, and the mining operations are declining. So there is an increase in demand of price of gold, and then the mining operation are declining, which hence leading to less production of gold, which will in turn increase the price of gold. And also we are going into an economic recession. The inflation is increasing on a daily basis. The purchasing power of dollar is declining. So we will see that precious metal will have a sharp increase in the in the prices. And those who are investing in precious metal, they will get a great amount of return. It is better than any 401k or IRAs that you're invested in. So that's all for now. Take care of yourself. Till then, we meet again. Don't stop being interested. Bye bye.